Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Hello students, my name is Ishan Chenolikar and today we will be discussing Principles of Economics Part 1. Let us look at the objectives of this session. To understand and explain the foundational principles that guide individual and collective economic decision making is the first objective. The students here will be able to identify trade-offs, assess opportunity costs and apply marginal analysis in real life scenarios. Next is to analyze how economic agents interact in markets and the role of governments in improving market outcomes. Here you students will examine the benefits of trade, the function of prices and the rationale behind government intervention. To evaluate how the economy functions at a macro level and the implementations of productivity, inflation and unemployment will be the next objective. Here you will understand key macroeconomic relationships and apply them to current economic events and policy debates. Let us start with the introduction to this session. So, economics is the study of how society manages its scarce resources. At its core, economics tries to answer a fundamental question, that is, how can we make the best use of limited resources to satisfy the infinite wants of individuals and society. These resources include time, money, labor, land and capital, all of which are finite. Individuals, firms and governments must make choices about how to allocate these resources most efficiently. The field of economics is broadly divided into two main branches: microeconomics, which focuses on the decisions of individuals and businesses and mechanisms of supply and demand and the allocation of resources in specific markets. It deals with issues such as pricing, consumer behavior, labor markets and competition. Macroeconomics studies the economy as a whole. It explores aggregate indicators like GDP, unemployment, inflation and national income, and it investigates how government policies, monetary institutions and global events impact the overall economic environment. One of the most accessible introductions to economics is provided by Gregory Mankiw, a renowned economist and a professor at Harvard University. In his textbook Principles of Economics, Mankiw outlines 10 fundamental principles that guide economic reasoning and help the students grasp the foundational ideas of the discipline. These principles are not merely theoretical concepts, but they are practical tools that shape how economists interpret behavior and policy outcomes are seen. These 10 principles are grouped into 3 broad categories. First is how people make decisions, which focuses on trade-offs, opportunity costs, rational thinking and incentives. Second is how people interact. Within that you have the examination of how markets function, the benefits of trade and the role of government. Third is how the economy as a whole works. This section explores productivity, inflation, unemployment and the interconnectedness of macroeconomic variables. Understanding these principles is essential for anyone interested in analyzing how economic systems function, making informed personal financial choices or shaping public policy. These foundational ideas serve as the stepping stones to more complex economic theories and applications. How people make decisions. Let us look at the first segment. Decision making is central concern in economics because all economic activity involves choices. Resources are scarce and individuals must decide how to best use them and satisfy their needs and desires. The first 4 principles of economics addresses this theme and explains the logic behind decision making process. Let us look at each one. First, we have people face trade-offs. Every choice involves a cost. Choosing one option usually means giving up the other. This principle is grounded in the fact that resources are limited in nature. For example, a student has limited time in a day. She can spend her evening either studying for an exam or working a part-time job. By choosing one, she sacrifices the benefits of the other. Similarly, governments face trade-offs, such as whether to allocate more funds to defense or to public health. Trade-offs are not always monetary. They often involve intangible factors like time, effort, and personal fulfillment. Understanding trade-offs helps individuals and policymakers to make informed decisions. Second is the cost of something is what you give up to get it. This is defined as opportunity cost. Opportunity cost is the value of the next best alternative, which is foregone. This concept focuses or forces the decision makers to consider not just explicit costs but also what they sacrifice when they choose one option over another. For example, choosing to attend college involves tuition fees, but the real cost also includes the income you could have earned by working during those years. For a firm, investing in a new machine has an opportunity cost if that capital could have been used for marketing or research and development instead. By considering opportunity costs, individuals and businesses can make more rational choices and maximize overall value. Third is rational people think at margin. Rational people make decisions by evaluating marginal benefits and marginal costs. Marginal analysis involves looking at the effect of small incremental changes in action. For example, a student deciding whether to study one more hour will compare an additional understanding she might gain, that is marginal benefit, with the leisure time she will lose, that is marginal cost. A company deciding whether to produce one more unit of output will weigh the revenue from selling the unit against the cost of producing it. This principle helps avoid the fallacy of all or nothing. Instead, it encourages optimizing outcomes through fine-tuned adjustments. Finally, in this section we have the fourth point, that is people respond to incentives. Incentives, which are nothing but rewards or punishments that influence behavior. They play a crucial role in shaping decisions. For instance, when gasoline prices rise or petrol prices rise, people may choose to carpool, switch to fuel efficient vehicles or use public transport. Similarly, tax breaks for renewable energy incentivize investment in solar and wind power. Incentives can be both monetary and non-monetary. Policymakers rely on this principle when designing laws and regulations aiming to influence public behavior through taxes, subsidies or penalties. In all, the first 4 principles of economics provide a framework for understanding how individuals and organizations navigate scarcity and make choices. These principles are not only useful in personal finance and business but also in crafting effective public policies. Let us move to the second part, that is how people interact. Economics is not just about individual decision making. Much of the economy involves interaction between people, whether they are buying and selling goods, working for wages or creating public policies. The next 3 principles will help examine how individuals interact in markets and what role the government can play to improve the outcomes. The first aspect in this is that trade can make everyone better off, which is the fifth principle. Trade is not a zero-sum game where one party gains and another party loses. Instead, trade allows individuals, firms and nations to specialize in what they do best and to enjoy a broader variety of goods and services than they could by producing on their own. For example, India exports software services and imports oil. This allows the IT firms to focus on what they are efficient at, that is IT services, while assessing resources they lack such as petroleum. Similarly, a farmer grows vegetables and trades them with a shoemaker, let's say for footwear, allowing both to benefit. Specialization and voluntary exchange increase total economic output and consumption possibilities, leading to mutual gains. The sixth principle is that markets are usually a good way to organize economic activity. Markets bring buyers and sellers together to contribute to and coordinate to economic activity. Through the price mechanism, resources are allocated efficiently based on supply and demand. Adam Smith described this as the invisible hand guiding self-interested individuals to promote societal welfare. For example, if the demand for electric vehicles rises, prices will rise, encouraging manufacturers to increase production. The market thus responds dynamically to consumer preferences and allocates resources to their most efficient use without centralized planning. Market economies have generally outperformed centrally planned ones in terms of efficiency, innovation and growth. However, markets are not perfect, and this leads to the next principle, that is, governments can sometimes improve market outcomes. While markets are efficient in many cases, they can fail. Market failure arises from issues like externalities, that is pollution, monopolies and information asymmetries. In such cases, government intervention can enhance efficiency and output. Without environmental regulation, for example, factories may emit harmful pollutants. Governments can impose taxes or regulate and internalize these externalities. Another example is antitrust laws, which prevents monopolies from exploiting consumers. Moreover, governments provide public goods like national defense and roads that private markets may not be able to provide or underprovide. Overall, it helps to reduce inequality. In summary, this section highlights that while free markets are powerful tools for coordinating economic activity, there are roles for public policy to correct failures and ensure fair outcomes. Let us look at the third section, that is how the economy as a whole works. The final category of economic principles examines how an economy functions at a broad or macro level. While individual decision making and market interaction are essential, it is equally important to understand the collective behavior of economies. The last three principles provide insights in long-run economic growth, the relationship between money and prices, and the trade-off between inflation and unemployment. So, our eighth principle is that a country's standard of living depends on its ability to produce goods and services. The most important determinant of a country's standard of living is its productivity, or the amount of goods and services produced from each hour of workers' time. Higher productivity leads to higher level of income and better quality of life for the population. For example, the average worker in the United States produces significantly more than the worker in low income country like Nepal. This is largely due to differences in technology, education, physical capital and institutional quality. As a result, an American would enjoy higher income and better healthcare, education and infrastructure as compared to another country. Countries can improve their productivity by investing in human capital such as education and training, physical capital such as infrastructure and tools, and technology via innovation and research. Policies that encourage open trade entrepreneurship and secure property rights also contribute to productivity growth. Moving on to the next principle, it says that prices rise when the government prints too much money. Inflation is an increase in general price level of goods and services in an economy over a period of time. One of the primary causes of sustained inflation is excessive growth in the money supply. For example, if the central bank of a country prints large amounts of money without corresponding increase in goods and services, then more money would chase the same amount of goods. This will lead to increase in prices. This has been witnessed in historical cases like Zimbabwe in the 2000s or Germany's way back in 1920s. This principle falls under the purview of monetary policy, which is managed by country's central bank. Central banks must carefully manage the money supply in maintaining price stability and avoid runaway inflation, which can erode purchasing power and disrupt economic planning. Moderate inflation is a good sign of growing economy, but high or hyperinflation is destructive. It erodes savings, distorts prices, and creates uncertainty in the economy. The last principle is that society faces a short-run trade-off between inflation and unemployment. In the short run, many economic policies influence inflation and unemployment in opposite directions. This relationship is often represented by Phillips curve, which shows inverse relationship between inflation and unemployment, at least temporarily. For example, if the government increases spending or central bank lowers interest rate, which are called expansionary policies, aggregate demand increases, leading to more production and job creation. However, this may also lead to higher prices, that is inflation. Conversely, tightening money supply can reduce inflation but may increase unemployment. This trade-off is particularly important in the short run, typically over a period of 1 or 2 years. In the long run, most economists believe that there is no such trade-off and the economy returns to the natural rate of unemployment, which is determined by structural factors. Policymakers, especially central banks, must strike a balance between reducing inflation and supporting employment. This is why central banks often have dual mandates to ensure policies and price stability and maximize employment. Now, what is the importance of these principles for BBA students? For students pursuing BBA, a solid understanding of these 10 principles is not just academic, but it is foundational in making sound business decisions and succeeding in corporate world. Economics equips BBA students with a framework to understand how consumers behave, how firms operate, and how markets function. Further, how government policies impact the broader business environment. It helps inform decision making. Principles like opportunity cost, marginal analysis, incentive management is useful for business managers. Whether it's launching a new product, allocating market budget, or optimizing efficiency, economics helps BBA students to evaluate trade-offs and make informed choices. Further, knowledge of supply and demand, the role of prices, and the benefit of trade enable students to interpret market trends and respond strategically. This is particularly important for roles in marketing, sales, and business strategy. Businesses do not operate in a vacuum. Principles related to productivity, inflation, and unemployment help future managers to anticipate economic cycles and plan accordingly. For example, understanding how interest rate changes affect investment and consumer spending, it is essential for financial planning. Policy and regulation awareness is also another important aspect. Economic principles explain why governments regulate markets and implement fiscal and monetary policies. This helps BBA students to understand the tax laws, business regulation, and implications of government interventions on industries. In an increasingly globalized world, trade and comparative advantage are key concepts. These principles help BBA students to analyze global supply chains, international trade policies, and the benefits of specialization across countries. Economics trains the students to think analytically and logically. This fosters a mindset of continuous evaluation and strategy development, which is crucial for leadership roles. In short, these principles form the intellectual toolkit of any business professional. They offer the analytical foundation for interpreting data, forecasting outcomes, managing risks, and identifying opportunities in a complex, ever-changing economic landscape. So, if you want to conclude the whole session, then the 10 principles of economics serve as a foundation for understanding how the world works through the lens of economic reasoning. They guide us in making personal decisions, interpreting market outcomes, and formulating public policies. Whether we are dealing with individual trade-offs or large-scale economic fluctuations, these principles provide essential tools for rational thinking in the world of scarcity and complexity. By internalizing these principles, students of economics can better navigate both micro and macroeconomic landscapes and provide meaningful discussions for better outcome towards economic issues at local, national, or the global level. I hope you understood and enjoyed the session. Thank you so much.